Are mining companies starting to take advantage of this pullback in the metals? Hello and welcome to the Northern Miner Podcast. My name is Adrian Pocobelli. And yes, indeed, for those that follow the ultra niche junior uranium mining beat, you may have noticed, and tell your friends if you haven't, Fission Uranium, a bellwether in the junior uranium mining space, has been taken out by Paladin Energy. Another known quantity, we might say, in uranium mining, of course, a much larger company based out of Australia. So over $1 billion, $1.1 billion Canadian. So kind of a big deal. And again, with uranium at $86.50 a pound, you get the sense that Paladin thought, here's our opportunity. Right? The metals, again, all pulling back here. Copper at $4.38 per pound. You know, it's amazing what 3 months, 4 months changes. There was a time when copper over $4 would have been seen as a big deal. Now, with our psychic adjustment now, after our brief history of copper shooting past $5, up to $5.18, at least on this program, now $4.38 is like, wow, what happened to copper? Funny how that works, isn't it? So that is my sense. Again, we see Agnico Eagle increasing its investment in Maple gold mines, and so just interesting developments out there. Now, looking out at the wider world, some interesting developments are starting to take place here. We've been seeing this here and there, maybe a couple of times I have commented on this port in Angola, the Lobito port. On Angola's Atlantic coast is a railway that runs from Lobito Port to the DRC and Zambia. And if you look on a map, and I highly encourage you to do so, you'll see Angola at the west of the DRC and Zambia, basically halfway across one and halfway across the other. And this is, of course, supported by the U.S. And you get the sense, you know, when you just look at the map, you can see what's going on here. Here is a way to get metal from the copper belt, in other words, the Democratic Republic of Congo and Zambia, over to the Atlantic, over to the West, over to the United States, over to Mexico, over to potentially Europe, right? So, and interestingly, this railway is not even quite built yet. So we have a couple of stories on this. And simultaneously, the U.S. is backing Angola's plan to process critical minerals and export them. So maybe the way that the U.S. is playing this is we want to make sure we have access to these metals, but if you want to make money in the processing of them, we're okay with that. We'll put some water in our wine. We don't need to make all of the profits on this metal, is what it seems like to me. And of course, Angola probably demanded that, one would imagine. This is Bloomberg News via mining.com. The U.S. is backing Angola's efforts to diversify from being an oil-dependent economy to becoming a critical minerals processor and exporter of clean power, according to a top official. And we have a quote from U.S. Assistant Secretary of State for Energy Resources Jeffrey Pyatt, who said at an online media briefing on Tuesday, quote, Angola and the United States are aligned on all the major points related to energy access, energy security, decarbonization, and critical minerals, end quote. The article continues, the Southern African nation, one of the top crude producers on the continent, has become a focus for the U.S. in its campaign to secure critical minerals such as copper as it competes against China. The U.S. Export-Import Bank has earmarked billions of dollars in clean energy projects to bolster capacity in the country that plans to sell excess electricity across the region. Pyatt last week visited the capital, Luanda, and met with the nation's oil and energy ministers. The officials discussed the construction of transmission and grid interconnection infrastructure needed for Angola to become a, quote, larger energy exporter to the rest of sub-Saharan Africa, end quote, he said. And just a last paragraph in this article, Angola is also interested in developing downstream processing infrastructure for critical minerals, he said, referring to Pyatt, adding that the U.S.-backed Mineral Security Partnership Forum brings producers and customers to find potential financing opportunities from the U.S., European Union, and others to realize such projects. So that is one article. So that was on June 19th, and we got another article that same day. Trafigura-led group orders 275 wagons for U.S.-backed Libido Rail. Also Bloomberg News via mining.com, and it says here, a group including commodities trader Trafigura has ordered 275 new container wagons for a key railway linking copper mines in the Democratic Republic of Congo to Libido Port in neighboring Angola. Gallison Manufacturing in South Africa is producing the wagons and will deliver the first set by the end of the year, the group known as Libido Atlantic Railway said in an emailed statement Wednesday. It didn't disclose the value. The group that also includes Portugal-based construction company Moda Engel SGPS SA and railway operator Vecturis SA has been running the concession since January and plans to spend $500 million to refurbish the line. The U.S. International Development Finance Corporation's board on June 5th approved a $553 million loan to Libido Atlantic Railway, according to the resolution posted to the Washington-based lender's site. The Libido Corridor is seen as a key export route from mines in Congo and Zambia for minerals critical to the energy transition, including copper and cobalt. The U.S. and EU, under the Group of Seven Partnerships for Global Infrastructure and Investment, are supporting the project as part of efforts to counter China's dominance in the Central African copper belt. The U.S. lender had initially planned a $250 million loan to the group, which aims to cut cargo transit times from Congo to Libido to days from the weeks it can take using other routes. The Africa Finance Corporation is the lead developer of a planned new connection that will link mines in Zambia to the existing Libido line in Angola. Italy committed $320 million to finance the project, according to a June 13th White House statement. So it's like William Sheriff said, sometimes the West lacks foresight, but it's really good at responding. That was really one of the huge takeaways, and I highly recommend that interview from maybe 3 weeks ago with Encore Uranium's William Sheriff. More interesting Africa mining news. This is the AFP, Agence France Presse. Major Niger uranium mine back in public control, according to the government. And this is AFP on Yahoo News. Niger on Monday confirmed one of the world's biggest uranium mines had returned to public control after revoking the operating license of French nuclear fuel producer Orano. For those that remember, is about last August, I remember being in vacation in Rhodes in Greece when the Niger coup occurred. Here we are in, almost July, and now Orano has lost control. The company last week said it had been excluded from the Imu Rarin mine in northern Niger in a move that highlighted tensions between France and the West Africa's country's military rulers. The government had not reacted before releasing a statement on Monday saying the Imu Rarin mine had returned to, quote, the public domain of the state. It justified revoking the license by saying Orano, quote, never honored its commitments, end quote, despite two formal notices handed to it by the Mines Ministry in February 2022 and March this year. Orano said on Thursday it had, quote, taken note, end quote, of the withdrawal of the license from its subsidiary Imu Rarin SA. The Imu Rarin mine sits on an estimated 200,000 tons of uranium used for nuclear power and weapons. So, of course, this has geopolitical impact. One would imagine this isn't just a gold mine, which you could argue actually also has geopolitical impact, but you could argue on the scale of importance. It's one of the larger uranium mines. Niger in 2022 accounted for about a quarter of the natural uranium supplied to European nuclear power plants, according to data from the atomic organization Euratom. So this is interesting as well. Something I haven't seen mentioned anywhere, but I've been mentioning here and there over the last few months is we're seeing a weird echo of the energy situation that we saw in Germany with the disruption of the Nord Stream pipelines and really the switching off of them by Germany at the beginning of the Ukraine war, and finally the dismantling of them by whomever. We're seeing a weird echo in the economic situation because, of course, I believe it's something like over 60% of France's energy comes from nuclear power. And where was that uranium coming from to power France's nuclear energy? Like one imagines a significant amount was coming from Niger, which raises the question, are France's energy costs going to rise in a similar manner to what we've seen in Germany? Kind of an interesting question that you don't see explored to nearly the same degree with all of the discussion that we've seen with Germany and Nord Stream. So interesting development there. Lots of Africa mining news here. Another interesting headline, this is Bloomberg News via mining.com. China is building Europe battery supply in Morocco, VW unit says. China is building a battery supply chain for Europe in Morocco as the continent struggles to develop its own industry to feed electric car manufacturing, PowerCo operations head said. And we have a quote from Sebastian Wolf, Chief Operating Officer for Volkswagen's battery unit, who said Tuesday at an event in Stuttgart, quote, "We don't have any supply chain. This has to be set up. Right now, we have to be honest that the setup of LFP supply chain is happening in Morocco and not in Europe," end quote. So Africa, at the heart of the story of this global supply chain, it's undeniable as we see this attention that's being given to Africa, how these countries are truly increasing in geopolitical and economic power. I think this is just another simple assertion and conclusion we can make here. Again, we're not dealing in numbers here. We're dealing in qualitative investigation. So circumstantial evidence, crossing stories together. We're trying to get a sense of what is going on from events, right? From facts as far as we can determine that they're true. And it seems to me that this is one of the very simple conclusions we can come to. Perhaps this seems even obvious, but I think it's worth stating here. Let's continue. China has a tight grip on global battery making, as well as raw materials like lithium, nickel, and cobalt needed to make them. And let's just actually look again at what the COO of Volkswagen's AG's battery unit said. Quote, "We don't have any supply chain." Think about that. Remember last week's episode, we were talking about Wuling and how really the fact that BYD is able to make a $9,700 car is not necessarily completely related to it being a quote-unquote better company. The real game changer, the real trump card, is being close to the supply chain, is owning the supply chain, one could argue. So this is a problem. If we listen to Sebastian Wolf here, COO of Volkswagen AG, again, we don't have a supply chain, period. This has to be set up. Continuing on, China has a tight grip on global battery making, as well as raw materials like lithium, nickel, and cobalt needed to make them. Europe is trying to build its own supply chain, but is years behind in terms of technology. At the same time, the region is losing investment to the US and Canada, where government financial incentives have been more aggressive. And this is quite interesting, too, and it harkens back to something Robert Friedland was saying at the Global Mining Symposium in London, was this idea that we needed to use something like iron for electric vehicle batteries. Listen to this. Lithium iron phosphate batteries are quickly gaining adoption as a less expensive technology that has become more efficient in recent years. China can produce LFP batteries at nearly half the cost of the global average, according to Bloomberg NEF. Morocco is rich in phosphate resources, key to making LFP cells. So it seems LFP stands for lithium iron phosphate. The country is also positioned on the doorstep of Europe and benefits from free-flowing trade with the US. So pretty interesting development there. And finally, on the electric vehicle front, a story from the CBC, will Canada join the US in a tariff battle against Chinese EV imports? And it says here, the Canadian government appears set to push back against the explosive growth in Chinese electric vehicle imports by joining its allies in a tariff battle that risks triggering retaliation from Beijing. On Thursday, Ontario Premier Doug Ford called on the federal government to immediately match or exceed U.S. tariffs on Chinese imports, including at least a 100% tariff on Chinese electric vehicles. Taking every advantage of low labor standards and dirty energy, China is flooding the market with artificially cheap electric vehicles. Unless we act fast, we risk Ontario and Canadian jobs, end quote. So there's a lot here. Now, interestingly, for those that don't know, Doug Ford, the Premier of Ontario, is a conservative. And this is more evidence, as we've been noting, that free trade has gone completely out of style. This used to be the banner of the right, at least what were sometimes called the country club Republicans, was free trade, and free trade. I mean, who out there now is asking for free trade? The pendulum has completely swung in the opposite direction. So more evidence on that front that free trade, completely out of style. Even conservatives are not embracing free trade. Who is embracing free trade? Maybe Rand Paul. So that is one thing. Another interesting aspect is the nature of the criticism. Taking every advantage of low labor standards and dirty energy, China is flooding the market. So we're back to this idea of potentially how important it's going to be to have basically an ESG sticker on your product. If you don't have an ESG sticker on your car, it will be probably tariffed to the moon. And one wonders, again, we've been seeing this incremental movement in the metals themselves, moving towards adopting a quote unquote green standard. Again, is this metal going to have that ESG sticker on it where you're going to be able to put the ESG sticker on your electric vehicle, on the laptop you're going to sell, on the phone you're going to sell, right? It seems like this is going to be one of the ways that the West tries to push back against not owning the supply chain in order to try and catch up here. So very interesting developments. Coming up, we have a wonderful show for you today, a fascinating interview with CPM Group managing partner Jeffrey Christian, one of the top gold experts in the world, and as I like to say, a sober analyst of the gold and precious metals markets, as well as industrial metals. We focus mostly on gold here. I've talked to Jeff probably more than a dozen times on this show. And what I love about it is I feel like every time we are pushing the conversation forward, in this conversation, you're going to hear how the physical market has a bigger impact on the price in the long term than the ETFs, which are more short term in their impact on price, which is just kind of interesting, isn't it? So just a very interesting discussion with Jeffrey Christian, bringing us all up to date on what is happening in the precious metal markets and macro, the U.S. election, and more. With that, if you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to the news. And turning to the website, Aramet BASF cancel plan to invest $2.6 billion in refining complex in Indonesia. This is Reuters via mining.com. French miner Aramet said on Monday it had decided, along with Germany's BASF, to cancel a $2.6 billion joint investment project in a nickel cobalt refining complex in Weda Bay, Indonesia. Very interesting, especially, within the context of that Volkswagen comment. We have no supply chain. And here's the quote from Aramet, who said in a news release, without elaborating, as Reuters puts it here, quote, after a thorough evaluation, including discussions about project execution strategy, both partners have decided against this investment. Aramid will continue to evaluate potential investments in the nickel electric vehicle battery value chain in Indonesia and will keep the market informed in due course, end quote. So, no real reasons given, but I have a theory. And I wonder if the nickel that's going to be coming out of Indonesia will not have that ESG sticker. That is the speculation that I have here, because why? It seems like they were happy. Let's continue the story here, only a couple more lines in it. In January 2023, Indonesian officials had said the French group and BASF were close to finalizing a $2.6 billion investment in the production of nickel for use in batteries for electric vehicles. The project was based on resources extracted from Aramet's mine in Weda Bay, which is Indonesia. Aramet had then confirmed negotiations were underway, but said the project was subject to a final investment decision. So what came up? We're left here without a clear explanation. I'm curious if you have any theories. Feel free to leave a comment on YouTube or on the Northern Miner website, and I will take a look and potentially read them here as well. Continuing on, Vale unveils $3.3 billion plan to boost copper and nickel output. This is Bloomberg News via mining.com. Vale plans to spend as much as $3.3 billion on improvements at its mining operations in Brazil and Canada to boost copper and nickel production capacity over the next 4 years. The Brazilian mining giant sees the potential to expand production capacity to about 500,000 tons of copper by 2028, mainly through investments to its Salobo and Sossego mines in Brazil, Vale said in its latest estimates for its base metals unit. Vale produced 321,000 tons of the wiring metal last year. Nickel also gets a capacity lift. So it seems for the first time since January, when all the nickel mines were closing, we're actually seeing now, only a few months later, a swing in sentiment towards nickel. Mark Cutifani, the former Anglo-American boss who leads the Vale Base Metals Board, on Thursday presented a plan that includes billions of dollars in capital expenditure initiatives to increase productivity and reduce costs in nickel and copper mines and processing plants. And scrolling down a bit, Vale broke out its base metals operations as a separate unit last year and sold a 10% stake to Saudi Arabia. The Rio de Janeiro-based metals producer has been assessing liquidity options for the business that may include a public offering. And finally, we have Citigroup analysts who wrote in a note to clients, quote, "The presentation was impressive, but many of the near-term concepts we have heard in previous presentations over the years." End quote, calling the base metals business a show-me story for equity investors. So Citigroup remains a touch skeptical. Sounds like it was a great presentation, but maybe how much has changed is what people are really asking themselves. Interesting questions and developments there. Let's continue. Friedland McEwen backed Power Nickel's oversubscribed $15 million funding. This is Cecilia Jamasmi at mining.com. Canadian explorer Power Nickel has closed its recent $20 million oversubscribed financing round backed by well-known personalities, including billionaire investor Robert Friedland and mining veteran Rob McEwen. The Toronto-based junior said the funds will be used to expand exploration on its 80% owned NISK property in Quebec, adding it hopes to take advantage of Canada's federal tax credit for critical mineral exploration. Power Nickel, which entered the project in 2021, noted it plans to deploy additional drilling rigs and advance exploration over the summer. NISK in Quebec's James Bay region is expected to become Canada's first carbon-neutral nickel mine by using carbon capture and hydroelectric power. Now, again, we're kind of back to the green sticker, to the ESG sticker. And let's not forget to give Robert Friedland credit where it's due, at least on this show. The first time I heard about the idea of a green nickel price was somewhere in like 2020, 2021, when Robert Friedland had done an interview at the Northern Miner discussing this idea that there would likely be in the future a green price for copper and a non-green price for copper. And it's interesting now to see him investing, as well as Rob McEwen, in this carbon neutral nickel. And just to repeat it, NISK in Quebec's James Bay region is expected to become Canada's first carbon-neutral nickel mine by using carbon capture, not totally uncontroversial, and hydroelectric power. The company has partnered with Australia-based Fleet Space Technologies to use ambient noise tomography to explore for nickel. The method uses satellites and handheld devices to capture background vibrations and develop 3D images of the subsurface down to 2 kilometers in depth. You get the sense when you hear this whole business could be turned completely upside down by technology in the next, few years here, if not as we speak. And scrolling down a bit, shares in Power Nickel have soared 267% so far this year, with most of the growth experienced since April 15th, when it reported initial drill results. The stock gained 23 Canadian cents on Friday, closing at 88 cents, which gives the company a market value of $150 million Canadian. Power Nickel also owns significant land packages in Canada's British Columbia and Chile. Now, one of the themes I do hear from exploration companies is a bit of a frustration being on the TSX Venture Exchange. Again, I like to call this a liquidity market. This is a market that loves liquidity. And so you see the biggest stocks are the stocks that everybody goes into, stuff that's easy to go in and out of. And one wonders if the thing that can bring back the venture markets is a story like Power Nickel. If all of a sudden you get 1,000% return on a stock, that's when people start to get excited. It's sort of like high stock prices are like a self-fulfilling prophecy, a bit of a feedback loop here, and they encourage more high prices. We see it in crypto, which is arguably just purely speculation. We see that speculative dynamic at work as well. Let's continue on. What we started the show with, Paladin Energy to acquire Fission Uranium for $1.1 billion in all-stock deal. This is Salima Virani at the Northern Miner. Fission Uranium has agreed to be acquired by Australia's Paladin Energy in an all-stock agreement valued at $1.1 billion. The acquisition will give Paladin the permitting stage Patterson Lake South uranium project in Canada's Athabasca Basin. It also operates its recently restarted Langer Heinrich uranium mine in Namibia. Under the deal, Paladin will purchase 100% of Fission shares at $1.30 at an implied equity value of $1.1 billion Canadian. Existing Paladin shareholders will own about 76% of the combined company, while existing Fission shareholders will own 24%. Fission shares closed at $1.03 in Toronto on Friday and rose to $1.18 late Monday. And we have a quote from Paladin CEO Ian Purdy, who said in a statement, quote, "Fission is a natural fit for our portfolio with the shallow, high-grade PLS Patterson Lake South project located in Canada's Athabasca Basin. The addition of PLS creates a leading Canadian development hub alongside Paladin's Michelin project with exploration upside across all Canadian properties." Fission President and CEO Ross McElroy noted the companies have complementary cultures and both sets of shareholders will benefit from the merger. And Ross McElroy has been CEO for quite a few years now. McElroy said, quote, "The combination of Fission and Paladin will create a world-class diverse uranium producer, adding a class-leading development project in a Tier 1 jurisdiction with the ability to expand production and cash flow profiles in the near term. With commercial production at Langer Heinrich and further development milestones at PLS, this opportunity will create a diverse, pure-play uranium company with current production and a deep pipeline of near and midterm assets available to investors. The deal offers a 13% premium to BMO Capital Markets target price for Fission and a 26% premium to the junior's last closing price," mining analyst Alexander Pierce said in a note to clients. And he further wrote, quote, "Significant on closing, the transaction would bring immediate exposure to a mid-scale producing uranium mine in Namibia to Fission shareholders. Further, the transaction could mark the beginning of additional M&A interest in the sector." End quote. So it is not finalized. The merger will require a shareholder vote on Fission's part with 2/3 approval. It will also require regulatory approval, including under the Investment Canada Act. Interesting. Continuing on, interesting stories out of the lithium market. China's Ganfeng sues Mexico over a lithium permit. This is Cecilia Jamasmi on northernminer.com. China's Ganfeng and two of its subsidiaries in Mexico have initiated an arbitration case against the country's government over a canceled mining concession for an advanced lithium project in the state of Sonora. The World Bank posted the request on Friday by Ganfeng's Bacanora Lithium and Sonora Lithium, a mining and processing giant in China. The Washington, D.C.-based Banks Dispute Settlement Center, the International Center for Settlement of Investment Disputes, is to hear the case. The dispute centers on the government's decision last August to cancel Ganfeng's concessions. That move followed then-President Andrés Manuel López Obrador's nationalization of Mexico's nascent lithium industry in 2022. In 2021, Ganfeng acquired Bacanora Lithium, which was in the midst of a mine development worth $800 million US. The company's goal at the time was to kick off commercial production in 2023, but Mexican legislators approved a bill in April 2022, granting the state full authority over lithium mining, and activities were halted. Ganfeng said the government could not lawfully cancel concessions, but Mexico's economy ministry upheld the original decision. So, interesting dispute there. You wonder if there's going to be more tension between Mexico and China as Mexico increasingly takes a share of Western manufacturing. So, just interesting development there. Continuing on, Tanchi weighs legal actions after Chile regulator clears SQM Codelco deal. A similar story. Of course, Chile doing a soft nationalization of its lithium industry as well. This is Reuters via mining.com. China's Tianqi Lithium said on Friday it was evaluating possible legal action against a Chilean regulator's ruling allowing a tie-up between number 2 lithium producer SQM and Chile's state-run copper giant Codelco. Chile's financial regulator this week said a planned lithium joint venture between SQM and Codelco can proceed without a vote by SQM shareholders, which would have included Tianqi. Tianqi has repeatedly pressed for the matter to be put to a shareholders' vote. It can appeal the regulator's decisions to the courts. And Tianqi said in a statement, quote, "Our company, in compliance with fiduciary duty and responsibility to its investors, is evaluating all possible legal actions and will take all pertinent measures in accordance with the law to enforce its rights and interests as a shareholder of SQM and an international investor." End quote. And another lithium story, SQM and Talga team up on Arrow Lithium project in Sweden. This is also Cecilia Jamasmy at northernminer.com. SQM, the world's second largest lithium producer, has inked an earn-in agreement with battery anode and advanced materials company Talga Group to jointly advance the Arrow Lithium project in northern Sweden. So we're seeing little movements here of Europe trying to build its supply chain. I'd argue this is evidence for that. The Chilean lithium miner can earn up to a 70% interest in Arrow by funding up to $19 million in exploration spending over 7 years. And Mark Thompson, managing director of Talga, believes a collaboration with SQM gives its company an opportunity to build a European lithium supply center. Quote, "As one of the few potentially large-scale lithium hard rock opportunities in Europe, Arrow might be significant to the region's battery and electric vehicle industry." End quote. And more lithium stories. Tesla and Yahua ink 3-year lithium carbonate supply deal, and this is by a staff writer at mining.com. China's Yahua Industrial Group has secured a new order from Tesla for its supply of lithium carbonate, a key raw material for the production of electric vehicle batteries. Under the purchase agreement dated June 19th, Yahua, through its subsidiary Yahua Lithium Yan, will supply an unspecified amount of lithium carbonate to Tesla between 2025 and 2027. There is also an option to extend by another year. So interesting headline there. Finally, on the lithium front, lithium's ongoing slump has traders searching for recovery signs. This is Bloomberg News via mining.com. Lithium industry watchers hoping the battery metal was poised to rebound from an epic slump have been hit by the realization prices have fallen again this month, with inventories piling up as electric vehicle demand signals stay gloomy. Spot prices of lithium carbonate in China have slid to the lowest since August 2021, and the most active futures on the Guangzhou exchange have lost 12% so far this month. In top producer Albemarle Corp's latest auction on June 19th, the winning bid was down 6.9% from the previous sale on June 5th. The declines follow a plunge of more than 80% in 2023 due to a glut and slowing demand growth. Although prices stabilized earlier this year, the supply chain is still working to clear inventories, with customers holding off purchases. The bearish sentiment has also been wreaking havoc on the stock prices of producers, including Albemarle and Piedmont Lithium. Scrolling down a bit, according to traders familiar with the matter, manufacturers grappling with slowing EV demand growth have been cutting orders for lithium products in anticipation that they may soon be able to restock inventories at even lower prices. Still, some traders say they see limited downside in prices, which have already been squeezing the margins of some higher-cost producers. Contracts in Guangzhou for July are the cheapest on offer, suggesting a bottoming out during summer. So lithium continues to struggle. Just a couple more stories. SouthStar nears startup of the America's first new graphite mine in over 25 years. This is by mining.com staff. SouthStar Battery Metals is preparing to start production at its flagship Santa Cruz graphite mine in Bahia, Brazil, within weeks. The company announced this week that it has made the final payment on the land purchase of 3.3 square kilometers required for its Phase 1 mine and plant facilities. Santa Cruz is scheduled to complete plant construction in June, followed by about 6 weeks of commissioning and production ramp-up. The current initial plant will be able to produce around 1,000 tons monthly once it reaches steady-state operations. And finally, Brazil is the second largest graphite-producing region in the world and has a history of more than 80 years of continuous mining for the mineral. And finally, Agnico boosts stake in Maple Gold as companies and Quebec JV. This is by a staff writer at northernminer.com. Agnico Eagle Mines has raised its stake in Maple Gold Mines to just under 20% after the companies ended their 50-50 joint venture at Douay and Joutel in Quebec last week. As part of the deal to dismantle the JV, Agnico bought roughly 33.8 million shares in a private placement priced at 12 cents per share for gross proceeds of $4 million. By market close Monday, Maple Gold traded at 8 cents per share, its highest year to date, for a market capitalization of $27 million. Prior to placement, Agnico held 40 million shares, or 12% of Maple's issued stock. It now owns 20% on a non-diluted basis. You just see how low priced, and not financial advice, and I don't own any mining shares, but you just see how low these stocks are. Maple Gold, with gold at a record, and here it is at its highest, share price year to date at 8 cents for a market capitalization of $27 million. And it seems Agnico is pretty darn interested in this project. Unbelievable. Again, not financial advice, and I don't own any mining shares, but wow, that is interesting. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.25%, edging up 0.02% from last week. The UK 10-year gilt is also slightly higher at 4.07%. That is 0.03% higher than last week. And the Italy 10-year bond is yielding 3.93%, also edging up 0.04%. from last week. So 10-year bond yields edging higher almost in unison. Turning to precious metals, gold is trading at $2,337.80 per ounce. That is $7 lower than last week, so edging slightly lower. Silver is trading at $29.22 per ounce. That is 35 cents lower than last week, so slightly lower on silver. Platinum is trading at $1,000.70 per ounce. That is $23 higher than last week. And palladium is also higher at $970 per ounce. That is $90 higher than last week. So up almost 10% in palladium, quite interestingly. Turning to industrial metals, copper is trading at $4.43 per pound. That is 6 cents lower than last week. Iron ore is trading at $106.96 per metric ton. That is 9 cents lower than last week, so almost even. Aluminum is a penny higher at $1.14 per pound. That is penny higher than last week. Lead is at 98 cents per pound. That is 2 cents lower than last week. Nickel is at $7.82 per pound. That is 4 cents lower than last week. And tin is at $14.82 per pound. That is 24 cents higher than last week. So a bit of a move in tin. Cobalt is unchanged at $12.32 per pound. Lithium breaks the $13 mark and is now at $12.88 per kilogram. Unbelievable. So the fall in lithium continues. That is down 42 cents from last week. Uranium also falling at $84.50 per pound, down $2 from last week. And zinc is unchanged at $1.29 per pound. Zooming out, really the star of the show has to be palladium, up more than 10% from last week's quote here. And also tin looking healthy, as well as zinc staying unchanged. Everything else looking more or less as if it's drifting sideways in a continued consolidation, really, at generally higher prices from where we were earlier in the year. And those are your metal prices. Coming up, I'm very pleased to welcome back to the program Jeffrey Christian, managing partner at CPM Group. We discuss the gold market, precious metals, what has happened in the last 3 or 4 months, where we are and where we're heading with this U.S. election and all of the uncertainty that impacts the gold price. So if you're looking to get a better understanding on what is impacting the gold price from one of the great experts of this industry, look no further, give this a listen. I hope you enjoy it, and I will see you on the other side. Join us today. I'm very pleased to welcome back to the Northern Miner Podcast, Jeff Christian, managing partner of CPM Group. Jeff, welcome to the show.
Oh, glad to be back.
It's awesome to have you, Jeff. What a year for gold that we've had. And I think the last time we talked to you was probably in somewhere around January, February. So it has been too long. Tell us, from your perspective, what's turning your head? What's changed in the gold market since we last talked?
I think what we've seen over the last, say, 4 months, since January, February, roughly speaking, is an accentuation of what we were seeing then. CPM Group had the view that 2024, 2025 would see a sharp increase in gold and silver prices as investors became increasingly concerned about political factors, a whole host of political factors, economic factors. We expected a weaker economy, possibly a recession in late 2024, 2025, and financial market uncertainties. And what we've seen over the first 6 months of this year is that the investor concerns about all of those factors have materialized sooner and more forcefully than we thought. We thought the first half of the year would be relatively quiet. And if you look at a price chart for gold or silver or copper or a lot of other commodities, January and February saw very stable prices. Gold was trading between 2,000 and 2,100 for 2 months. And then in March, April, May, you saw a breakout. And that was investors becoming more concerned about politics, economics sooner than we had thought. We thought that this would start to emerge in the third quarter, but it actually started emerging in the first quarter. And you saw a very strong investment demand for gold and silver pretty much on a worldwide basis. The one place where you saw weakness was, gold ETFs. You saw continued selling, but that wasn't bearishness about gold. That was concerns about the financial counterparty risk inherent in ETFs. And, some of those investors were selling their ETFs and buying physical gold. But we saw much stronger investment demand sooner than we had expected. And as a consequence, the gold price and silver prices have risen somewhat sooner than we expected. We thought we'd see prices around 2,400 gold in the last 4 months of the year. We thought we'd see $30, $31 silver in the last 4 months of the year. But in fact, we've seen them in May and June.
Very interesting. And just to clarify, as far as what caused that global, demand for gold, was there a specific event? Because when I look back now, I say, well, what happened? The Ukraine war has been ongoing. The Israel-Hamas situation has been ongoing. When you look back, is there a certain event that you see, or is it just a sense of consternation kind of gathering pace and kind of hitting a crescendo, so to speak?
One of the points we were making in late 2023 and early 2024 was we're saying that, generally speaking, economic and financial issues are the key drivers in investment demand that determine whether investors are buying or selling, raising the prices of gold and silver. But that we thought that in 24 and 25, you would see political factors taking a much more prominent role in influencing investor attitudes. And I do think it was that. I don't know that there was any specific individual factor that was involved, but, in the March, April period, by that time you had 5 months of Israeli warfare in Gaza, and the full specter of the humanitarian crisis that was being created and the potential war crimes and the hostilities toward the Israeli government, not Israel, but the Israeli government and its prosecution of this war by governments and individuals around the world, Europe and the United States and Canada specifically, traditional allies of Israel saying, hey, you guys are just doing this wrong. And US starting to pull back. I think that in March, April, you started seeing not any single factor, but a number of factors grow worse. So you had the heightening international issues related to Israel's invasion of Gaza. You also had an ongoing stalemate in the US government, which was holding up funding for Ukraine. So you had Russia starting to make military gains in the east and north of Ukraine. And you started seeing people say, oh, wow, Russia, thanks to the US GOP, Russia could actually win this war. You also had a growing awareness of the pathetic nature of the US presidential election. And you had growing awareness of the hostilities and divisions, not only politically, but socially within the United States. And you also had growing tensions in Europe, in Russia, in China, in India, in South Africa. You had worsening political environment around the world. And I think there was no one spark, but there were a whole bunch of sparks that just sort of said to people, hey, this is bad. And then at the same time, you started to see signs that, yes, the US economy was still in healthy shape, but there were negative issues starting to arise. You also had investors starting to say, wow, maybe the Fed's going to do what it's been saying it's going to do and not lower interest rates as rapidly as we would like. So you had a combination of factors that I think collectively caused investors around the world really to say it's risk off time. So you saw a surge in US Treasury securities purchases. You saw an increase in the US dollar. And you saw increased demand for gold and to a lesser extent silver. All of those things are risk off assets. When investors get concerned, they move toward the dollar, US Treasuries, and precious metals. And that's what you were seeing over the last 4 months.
Interesting. And if I remember right, just a final point on this, to your point, the dollar and gold were going up oftentimes at the same time. Is that what you recollect?
Yes, they were. And that's not unusual in this kind of political and economic environment. I remember in 1979, I had this dunderheaded fellow who worked with me, and he would come in every day and say, the dollar and gold can't rise at the same time. And I would say, but they are. He had a theory which was totally misbaked, too much sugar in his, not enough flour in his cake. He had this theory that he was living by. And I just looked at the empirical evidence. And I said, the fact of the matter is the dollar and gold were rising at the same time in 1979 because investors around the world were looking at a similar menu of economic and political crises that were continuing at that time.
Now, you recently released a video on your YouTube channel, and you were suggesting that it was possible that we might see a short-term spike in silver and gold in the near future. Is this based on a broad theme, or is this more of a, what we might call a market technicality?
It's a market mechanism that's going on. I mean, you have to divide CPM Group's forecasts temporally, So we have been talking about a more substantial upward movement in silver prices in 2024, 2025 for about 4 years now or so. And actually even longer than that. I think we traced it back to like 2016 or so. And that is still in place. But what we were talking about in the video was an extremely short-term factor that was just based on some mechanicals that are going on in the July COMEX silver futures contract. where you have, as of last Friday, you had 305 million ounces of July open interest that becomes deliverable this Friday. And most of the people who are short July futures will want to buy those back and sell September or December futures forward. So they'll roll their short position forward. And that roll sometimes, not always, usually it doesn't, but sometimes you'll see that the roll of a nearby active contract in gold or silver or in oil or in copper or other commodities can have the price spike up. When you look back at April 2011, which was when silver prices on an intraday basis peaked, they went from $36 an ounce at the beginning of April to $50 at the end of April. That was due to the May contract rolling into July in 2011. And once that roll was over, the price fell to $32 within like 5 trading days. And what we were saying in our video last week was that if you look at the July contract today, you've got this 305 million ounces of open interest, 63 million ounces of registered stocks. You could see the price of silver spike higher over the next 4 or 5 trading days and then come off in July. We don't see it plunging, but we could see a very brief spike higher this week, followed by a price falling back to the lower end of recent trading ranges once you get into July.
That is fascinating. I mean, very specialized, specific information on the silver market there. Just fascinating. So, zooming out a little bit, then, what's driving the gold market right now? Who's buying gold? Who's selling it? What are you seeing in terms of flows from your perspective over there?
The demand for gold over the last couple months has been pretty generalized. We've seen retail investors and we've seen institutional investors move into gold. March, April, May, kind of plateauing since the middle of May, but at record high levels, But we've seen retail, we've seen institutions, we've seen demand in China, India, the United States, Canada, Europe. You saw a wave of institutional demand in that April and May period of time. Central banks have actually pulled back some from buying as much gold, specifically the People's Bank of China. They're buying like 150,000 ounces a month right now, which is down from about 650,000 ounces a month last year. So they pulled back. Other central banks have also pulled back from buying, partly because they're more price sensitive. When the price was $2,100, $2,200 last year, okay, these are high prices, but maybe the price is going to go higher. But now at 2,300, 2,400, a lot of central banks say this is just too high. I will wait, see if we see that summer pullback. There's seasonal weakness in gold and silver prices in June, July, August. And if we see the prices pull back to 2,200 or 2,100, then we probably will come back as buyers. So central banks have kind of pulled back. I mentioned earlier, ETF holders have been continued sellers. There was a spat of time when the gold price was rising sharply in early April when they actually appeared as buyers, but then they pulled back since that time. But that is interesting phenomenon, which is, as I said, the ETF selling, which has been going on for 3.5 years now, has coincided with increased demand for physical gold globally from investors. So investors are buying more physical gold, and investors who have bought their gold exposure through ETFs have been selling. Now, the problem for the gold market is that the ETFs report on a daily or a weekly or a monthly basis. There's data, how much is being bought or how much is being sold for ETFs. The rest of the market, which is more than 90% of the demand for physical gold, is not reported anywhere. So it's very secretive how much gold is being bought by investors. So people who are looking at the gold market from, let's say, the outside or not from the inside, say, well, what are investors doing? Well, the only data I have are ETFs, And ETF investors have been selling for the last 3.5 years, like more than 20 million ounces. So I don't understand why the gold price is rising. And the answer is the gold price is rising because all the other investors are buying, and the ETF holders are saying, I've got concerns about counterparty risk in my ETFs, and I'd rather own gold directly stored in a bank vault or a non-bank depository than have a share in a Channel Island ETF. So that's where you've seen the weakness. And unfortunately, for a very secretive precious metals markets, that's the only data that's publicly available.
This is fascinating. And my simple view of this, I want to kind of bounce it off you to get your view on it. Like, my simple view of this would be the buying of physical gold and the securing of that would have more of an impact on the price than a derivative or an ETF, which I think we could call a derivative, so-called paper gold. What do you think of that? If as many people bought physical and then sold the ETF, would that balance out, or do you think that has a greater impact on price by people wanting the physical?
Well, first off, the ETFs we follow actually buy physical metal. So, a derivative is a future or a forward or an option or a gold index note or something like that. ETFs are kind of hybrid because they actually are buying physical metal, but in and of themselves, they're shares of a company that owns that precious metals. So they're kind of a derivative. But our research over the last 50 years now, 49 years, our research shows that it's the physical demand that has the major impact on long-term gold and silver prices. And the derivatives or futures and options, they will affect the price in the short term, like 1 week, 1 month, 3 months, 3 months at the most. But the gold price and the silver price are determined at the end of the day by physical supply and demand on a longer term basis. The futures and other derivatives only have a short term effect on the price.
So, zooming out again, Jeff, in your view, to ask kind of a simple question, but let's see where it leads, like, are we in a bull market in precious metals right now?
Yeah, that's like this philosophical question: what is a bull market? But my answer is, again, temporally conditioned. So, in a short term basis, like since 2019, yes, we're in a bull market. In terms of a longer term view, we've been in a bull market since 2000, 2002, and we continue to be in that market. We had a big increase from $250 in 2000 to like 1900 or so in 2011. And then we had 5 or 6 years of downward movements from 2012 through 2016. Price moved sideways for a while into 2019, 2020. And then it started what is, in our view, the second leg up in this really long-term secular bull market. The first leg of which went from 2000 to 2011. We see the bull market that started in 2020 as the second leg that could see a similarly sized move. So from a long-term perspective, we think we're in a bull market. From an intermediate term view, the past 5 years and the next 2 years, we think we're in a bull market. We do think that at some point the price will come off, but it's not going back to where it was prior to 2020, in our view. And then in a really short-term view, like the next 2 months, we think that you could see the gold price come off, partly because of seasonal weakness and partly because it's risen so far so fast. And you're starting to see some of that stale bull questioning of the sustainability of the shorter term move on the part of people who came rushing into the market in March and April into the first half of May. When the price went from $2,050 to $2,450, you had a lot of new people coming into the gold market, and the price peaked at $2,450, and it's been trading between $2,300, $2,400 since that time. Some of those people are saying, oh, gee, maybe I bought at the peak. I think they're wrong, but I think you might see some of them taking profits over the course of July and August.
And do you think if we were to try and attribute causes to that bull market, oftentimes you'll mention the real rate of return on treasuries and basically saying, if you're getting over 3% real rates of return, that's not great for gold. But as long as we are under that 3%, generally that kind of puts a bit of a fire underneath the gold price. I mean, ultimately, do you see that as, if not the primary factor, a major factor driving this move?
Absolutely. That 3% threshold, that's based on historic activity. It's not like a theoretic thing. It's based on, since gold prices were freed in 1968, what has been the relationship between real interest rates and gold price changes. And below 3% real rates, investors say, I'm interested in gold for part of my portfolio. Over 3%, they start saying, well, maybe it's not. And part of that actually reflects what's the interest rate. If real interest rates are over 3%, that reflects a very strong economy, and that reflects strong stock markets and also strong returns in interest-bearing assets. So, it makes sense that you've got that. And that's definitely one of the big factors there, is that when you can get a good return on interest-bearing assets, it reduces the attractiveness of gold and the competitive hypothetical returns that you could derive from it. And it also reflects a stronger economy and therefore less concerns about the state of the economy and fewer impulses that you need to have more of your money in gold because the economy is weakening.
Okay, excellent. And as far as inflation is concerned, what is your view? Like, one of the things that I wouldn't call it a secret weapon because it's not a secret, but one of your kind of ways of projecting out how the, metals will act is having a good sense of the macro, right? So as far as your view on inflation and the Fed, what are you seeing with that whole dynamic and that little dance that we're seeing, every couple of weeks here on TV?
There are many things that people say that I just can't believe that they're saying. And one of the things that I hear all the time is, oh, the Fed is losing control, or the Fed is failing, or the Fed will fail. It's really, if you know anything about fiscal policy as well as monetary policy, those are nonsensical statements. Anybody who says the Fed is failing or the Fed has failed or is running out of ammunition don't understand monetary policy these days. So I do think that, those things are important there, but we're looking at inflation and we're seeing cyclical inflation coming off. Some of the inflationary pressures that you saw in 2020, 2021 into 2022 are dissipating. We've gotten out of the lockdown. We've gotten over the semiconductor shortage. We've gotten over all of the supply chain interruptions, pretty much. So a lot of those inflationary pressures that pushed CPI in the US up to 9% have dissipated. But you have some other secular or longer term inflationary pressures that are still there. One is the fact that you've had real earnings of 90+% of the population lagging real earnings of the other 5% and the cost of living and everything for decades. And you now have a brief period of time of several years where you have increased pricing power on the part of workers. So you're seeing upward pressures, inflationary, partly on wages, and it's mostly in transportation and medical services right now. You're also seeing shortages and upward pressures on housing. That's partly because the housing industry, like the auto industry, has not paid attention to the demand and needs of home buyers. Home buyers are primarily starter home buyers and people my age who are looking to downsize because they're empty nesters. And they want smaller houses, but the margins that home builders can get on McMansions is so much greater. They're building McMansions that no one can afford or want, and they're ignoring the smaller homes. The other big pressure on housing prices is the rise of institutional investors buying these houses. and squeezing out the market. If you had regulations that prohibited institutional investors from buying entire tracts of subdivisions and renting them out, you would take out like 25% of the housing demand right now, and the housing prices would fall. Housing would be much more affordable for actual homeowners who want to buy houses. But that's not going to happen because if the people who are running those institutions are very powerful and they contribute tremendously to congressional and presidential campaigns. So no one in Congress and no one running for president is going to take away this money bag that these guys have. So you have longer term pressures, housing, transportation primarily, that will continue to keep inflation higher and above 2% and will be headwinds to the Fed and other monetary authorities trying to lower inflationary pressures. But you have a lot of other cyclical pressures that are coming off the market right now.
And so the medievalization of society continues with these corporations buying these huge tracts of housing. Pretty outrageous, actually, dare I editorialize here. But which brings us to my final question here before we wrap up, Jeff. You mentioned the presidential election, and of course, another just massive source of uncertainty, which we also know plays a role in the price of gold. What are you seeing as a final question here, as an outlook with the U.S. presidential election coming up in November? What factors do you see here that we should be looking at as it starts to play out?
Well, gold investors respond primarily to uncertainties. And this is going to be a very close election. And Mr. Trump is already, and his colleagues, not just him, but other people throughout the GOP have said, the only way the Democrats can win is if they cheat. Ergo, regardless of the outcome of the election, we will contest it. So this is going to be one of those very nasty contested elections. And that is going to create a tremendous amount of uncertainty and concern on the part of investors, which should be reflected in increased demand for gold and silver and consequently higher prices. I mean, our CPM Group has been saying that we thought that gold and silver prices would rise sharply in the last 4 months of this year into 2025 is the U.S. election and its likely aftermath.
Jeffrey Christian, managing partner at CPM Group, thank you once again for joining us and sharing your very unique and valuable insights on this week's Northern Miner podcast. And thank you once again to Jeffrey Christian for appearing on this week's Northern Miner podcast. It was a fascinating discussion, particularly on the physical versus the ETF in regard to how it impacts the price. Very interesting subtleties there in understanding how that very interesting market works. And thank you, dear listener, for listening. I hope you enjoyed the show. If you want to help out the podcast, please leave us a review in the Apple Podcast directory, share it with your friends, and until next week, take care.